we are pleased to once again be joined by the CEO of Euro-Pacific Capital, Peter Schiff. Peter, thank you so much for being with us again. You've been calling for a correction for a long time, more than that actually, more than a correction, and this is certainly a correction. The Dow down sharply, the S&P also, and NASDAQ down. Again, yesterday was no bargain either. Is this it, Peter?
Well, I've been calling for a bear market, and I think this is a bear market. And if we get a rally, that will be the correction, because the primary trend is now down. This is early in this bear market. It's very young, and unfortunately, it's going to be very long-lived. I think this is going to be similar, if not worse, than the bear market that went from 1966 to 1982. It took 16 years for the Dow to make a new high. And during that time period, inflation took about 70% away from the Dow's value. This time, I think it's going to be worse.
And why do you think that? I mean, at the initial point right here, Peter, is it that some traders just don't want to face the music, even if it's downer tunes?
They don't even understand the music or what's playing. What they don't get is that we are about to finish the financial crisis and Great Recession that started 10 years ago in 2008, because all the Fed succeeded in doing was interrupting that process, which was the market's cure for the underlying economic disease, which is now much worse. 10 years of additional debt, borrowing and spending simply allowed us to reflate an even bigger bubble than the one that popped before. And so as a result, we're in much worse economic condition than we were on the eve of the last crisis. And so now the finishing process is going to be far more severe. So the back half of the Great Recession is going to be much greater than the first half. And the rest of the financial crisis is going to be much worse than the beginning. And people just don't get that yet. And it's going to take a long time for them to figure it out. I mean, maybe not that long, maybe months, we'll see. But in the meantime, everybody thinks this is a healthy correction. There is nothing healthy about what's going on. This is a bubble deflating. This is exactly how it started in 2008, only this is a bigger bubble, and it's going to produce a bigger crisis.
You know, you've said this before, and I want to, if you'll pardon me, I want to sort of tease it out a little bit more. So, you know, part of the problem back leading up to 2008 was the unregulated markets, the mortgage-backed securities, and those over-the-counter things that, you know, weren't regulated, and rampant speculation. But why do you say that this is a bigger problem than then, Peter? I'm sorry to have you do a little remedial stuff for us, but I'm very curious.
Well, that's a common misconception that was all these underregulated or non-regulated markets. It was the regulated products, you know, Fannie Mae and Freddie Mac, you know, these were the entities, and, you know, what they were doing was subprime. But remember, the fuel for that bubble was not the mortgage lenders. It was the Federal Reserve, which kept interest rates artificially low. They kept interest rates at 1%, which at that time was the lowest they'd ever been. They left them there for an entire year. And then it took 2 to 3 years to normalize back up to 5%. But, you know, we took on a lot of debt when interest rates were artificially low. A lot of it was mortgage debt, and the bubble popped. But this time, the Federal Reserve injected far more monetary heroin into the economy. They kept interest rates at 0 for 6 years. They've been raising them for 3 years, and they're just now back at 2%. So you have 9 years so far of extremely artificial low interest rates, which have caused a much bigger credit bubble than the one that popped in 2008. We have a bubble in real estate. We have a bubble not only in residential but commercial. We have a bubble in stocks. We have a bubble in bonds. We have bubbles everywhere, and they all popped. And the air is coming out, and the economy during these 9 years got way more screwed up than it did during the years that Greenspan inflated the housing bubble. The Bernanke, Yellen, and now Powell bubble is far bigger. So the economy is in much more trouble. And so therefore the process of unwinding all these malinvestments, right, liquidating all the mistakes, and, you know, a lot of money is going to be lost, far more money than was lost in the collapse of '08. And the difference is the Fed is not going to be able to bail anybody out. There is no bigger bubble that the Fed can blow. This is it. They're done blowing bubbles. We now finally have to deal with the consequences. And because we kicked the can down the road for so many years, the consequences are much more severe than they would have been had we bit the bullet and dealt honestly with them earlier.
We totally blew our time talking about that. But I appreciate it so much, Peter, going back. I mean, from my view, I get what you're saying and agree about, the lower interest rates. But boy, those OTC products that nobody knew about seem like a problem to me as well. I think in tandem with what you said about Freddie and Fannie. Peter, this is asking a lot because we're out of time, but I'd sure like you to come back in the next week and talk about some of these specific stocks that we were going to get to, but we didn't now. I thank you so much for your time.
I got time if you want to talk about them.
Right. I know you do. Unfortunately, we don't today, but thank you. The CEO and Chief Global Strategist at Eurus Pacific Capital. Thank you, Peter. Appreciate it.